Okay, let's dive right into this explainer and look at the Reserve Bank of India. We aren't just talking about a regular bank here. We're talking about the ultimate manager of a massive, bustling financial metropolis. Whenever we hear about the RBI in the news, it's usually buried in some pretty heavy financial jargon. Repo rates, monetary policy, things like that. But if we strip all of that away, what exactly does this institution do on a day-to-day basis? Well, today we're going to break down the absolute core functions of the RBI using an incredibly intuitive foundational map.
To make sense of it all, we're splitting the RBI's duties into three distinct districts: traditional, promotional, and supervisory.
What's really fascinating is that the foundation for our entire mental model today comes from actual handwritten source notes. There is something profoundly clarifying about seeing complex macroeconomic principles distilled down into simple bullet points on a piece of paper. The author perfectly captured the RBI's identity by splitting it into those exact three pillars. It's seriously the perfect blueprint for understanding how the whole shebang works.
So, let's start with district number 1, traditional, the system's core.
These traditional functions are the baseline requirements. They are the everyday mechanics that keep the country's money flowing. At its absolute core, the RBI is the sole issuer of currency. Every single rupee note in your wallet right now, it's there because the RBI put it into circulation. And as the source notes point out, this also includes the massive logistical headaches of withdrawing currency, like demonetization. But beyond just printing money, the RBI acts as the government's own personal banker. Just like you have a bank account for your salary and bills, the government uses the RBI to handle public borrowings and collect payments, like your income tax.
Moving down the list, the RBI acts as the banker's bank. Think of them as a very, very strict school principal. If you want to start a bank, you need their permission, a literal license to operate. Want to open a new branch across town? You got to ask the principal. They even have to approve top-level management to make sure competent people are in charge. And if things really go south, they hold the absolute power to order closures. They are, without a doubt, the ultimate authority in the banking schoolyard. Now, this brings us to their ultimate financial backup plan, acting as the lender of last resort. Imagine a commercial bank suddenly runs out of cash and literally cannot borrow from anyone else to pay back its depositors. That is a recipe for total panic, right? To prevent a full-blown bank run, the RBI steps in. They provide emergency funds, actually pulling from their own cash reserve ratio to rescue banks that have absolutely zero other options. To manage the massive flow of credit in the economy, the RBI uses a system that's remarkably similar to setting up an emergency stash in your own household budget. They dictate exactly how much money banks must lock away and keep safe, rather than just lending it all out. This stash is split into two very distinct categories, CRR and SLR.
First up is the cash reserve ratio, or CRR. This is exactly like the cash you hand over to a highly trusted friend, in this case, the RBI, so you are completely forced not to spend it. The notes make a really clear distinction here. CRR must be kept strictly as cash, and it physically leaves the bank to be deposited with the RBI.
On the flip side, we have the statutory liquidity ratio, or SLR. Think of SLR as the emergency stash you keep hidden at home. It's like gold or safe assets locked in a drawer. SLR can be held in gold, government securities, or cash, and crucially, it stays within the bank itself. Now, the genius part here, as highlighted in the source, is that because banks buy government securities to meet this SLR quota, SLR indirectly allows the government to raise money. It's an absolutely brilliant two-birds-with-one-stone mechanism.
So why does all this systemic regulation actually matter for your wallet? Well, the safety of your personal deposits comes down to one crucial number: 5 lakhs. That is the hard safety limit insured per depositor per bank. This ultimate safety net is provided by the Deposit Insurance and Credit Guarantee Corporation, or DICGC. It's a subsidiary of the RBI. But here is the fascinating part that is clearly underlined in the source notes. You don't pay for this insurance directly. The banks themselves are mandated by the RBI to pay the premium to the DICGC to protect your money up to that 5 lakh limit. Rounding out the traditional district, the RBI also serves as a clearinghouse. Basically, they settle the massive, complex web of transactions happening between different commercial banks every single day. And they also manage foreign exchange control, which has transitioned over the years from the rigid rules of FARA to the much more modern, flexible management of FEMA, keeping the country's foreign currency reserves completely stable.
All right, moving on to district number 2, promotional, fueling the future.
While those traditional functions keep the lights on, the promotional functions are all about expanding the city. The RBI doesn't want banks to just sit still. They aggressively push for growth. They encourage branch expansion, sometimes going so far as to ask robust banks to literally adopt a branch to bring banking to unbanked areas. Plus, to fuel specific, critical sectors, the RBI helps spawn specialized institutions. For heavy industry finance, they backed giants like IDBI and ICICI. And for the massive agricultural sector, they created NABARD, the National Bank for Agriculture and Rural Development.
If we look at the second page of our source notes, it's really revealing how these promotional efforts are structured. The author actually groups the DICGC, that deposit insurance we just talked about, under promotional functions. And honestly, it makes perfect sense. Why? Because insuring depositors builds immense public trust. And public trust is the absolute non-negotiable prerequisite for an economy to grow. It literally acts as the growth engine for the nation's financial inclusion.
And finally, we enter our third district, supervisory, the watchdog. This is where the RBI takes off the builder's hat, pins on a badge, and becomes the ultimate enforcer. To keep banks honest, they enforce strict classification rules for loans, which banks refer to as assets. It's basically a financial traffic light system. When a loan is being paid back on time, it's a standard asset. Green light, we're good. But if payments stop, the RBI forces the bank to downgrade it step by step. First, it becomes substandard. That's your yellow light of warning. Then it becomes doubtful, red light, and finally, a bad asset, a complete crash. Banks can't just sweep a bad loan under the rug. This forced categorization ensures the RBI knows exactly how healthy or sick a bank's balance sheet truly is.
When you step back and take in this incredible blueprint we've unpacked today, from the traditional mechanics of issuing currency to the promotional engines of rural development, right over to the supervisory watchdog mechanisms, it is genuinely awe-inspiring. The RBI is not just a bank, it's this incredibly intricate balancing act. It really makes you wonder, considering just how fast the global economy moves today, how much coordination between these three massive pillars does it actually take to keep the sprawling financial city running perfectly, day in and day out, without collapsing? It is a massive testament to the complex, hidden architecture that makes our modern lives possible.